Picture this. You walk into a store in New York. You buy a bar of silver for $70. You walk outside, get on a plane to Shanghai, and sell that same bar for $120. You do it again, and again, and again. And every time, the profit is the same, $50 per bar every single time. Now you're thinking, that sounds like the deal of a lifetime, and you're right. But here's the part that should terrify you. This isn't a hypothetical. This is happening right now, February 2026, in the largest commodity markets on Earth. And the gap isn't closing. It's widening every single day. My name is OG John AG. If you're watching this channel, you know I don't do hype. I don't do fictional stories. I do data. I do math. And the math right now is breaking in a way I've never seen before. 75% of you watching this are not subscribed. Hit subscribe. Drop OG John AG in the comments. That engagement is the only thing keeping this channel alive, because the kind of information I'm about to give you is the kind certain institutions would prefer you never hear. Now let me ask you a different question. If someone put a crisp $100 bill on a table and offered to sell it to you for 41 cents, what would you do? Would you call the police because you think they're insane? Or would you empty every pocket, every wallet, every savings account, and buy every single bill they had? The answer is obvious, but here's the glitch in reality. The financial market, home to the so-called smartest minds on the planet, the Ivy League quants, the algorithmic trading firms, the trillion-dollar hedge funds, they are staring at that $100 bill right now. And they're saying no thanks. They'd rather buy a digital picture of a monkey for $1 million. That is not an exaggeration. That is what is actually happening. And by the time you finish watching this video, you will understand exactly why this is the single greatest pricing error in modern financial history. And more importantly, you'll understand why it cannot last. But first, let me set the stage with a number that should shake the foundations of everything you think you know about supply and demand. Global silver demand hit 1.24 billion ounces in 2025. Total supply, including every mine on Earth and every ounce of recycled scrap, came in at 1.01 billion ounces. That's a deficit of 230 million ounces in 1 year. That's equivalent to the entire annual output of Mexico, the world's largest silver-producing nation, simply vanishing into thin air. And this wasn't a one-time event. This was the 5th consecutive year of deficit. The 5th. The cumulative shortfall from 2021 to 2025 stands at 820 million ounces. That is nearly an entire year of global mine production that the world consumed but never replaced. Gone. Absorbed into solar panels that will sit on rooftops for 30 years. Embedded into electric vehicles that will drive until the wheels fall off. Locked into semiconductors that will process data until they're obsolete. Silver that went into industry doesn't come back. It's a one-way trip. And the world just used 820 million ounces more than it produced over 5 years. And somehow the price on your screen is supposed to reflect reality. It doesn't. And the reason it doesn't is the most important financial story nobody is telling you. Now, before we go further, I want to know where my people are. Are you stacking silver in London? Are you watching gold in Mumbai? Are you sitting in a basement apartment in Brooklyn wondering if you should sell your index fund and buy metal? Drop a comment below. Tell me where you are and what you're holding, because what I'm about to share isn't for tourists. This is for people who smell smoke and want to know which building is burning. Let me take you to Shanghai. Not the tourist version with the neon lights and the Bund. The real Shanghai. The Shanghai Gold Exchange, where physical silver trades, where actual metal changes hands, where the price is set not by algorithms trading paper contracts back and forth 1,000,000 times a second, but by people who want to hold real silver in their hands. As of early February 2026, silver on the Shanghai Gold Exchange has traded above $86 per ounce. At that same moment, Western spot silver, the price you see on your screen in New York or London, was sitting around $70 to $78, a premium of $10 to $15 per ounce. And during the crash in late January, when Western paper silver was plummeting 30%, the Shanghai premium exploded. It hit 29%. Factor in China's 13% VAT on physical withdrawal, and the effective wholesale premium reached 45.8%. Let me say that more clearly. At the exact moment paper silver in New York was crashing, physical silver in Shanghai was trading at nearly 50% more. Paper went down, physical went up, at the same time, in the same commodity, on the same planet. If paper silver and physical silver were the same thing, this would be impossible. The fact that it's happening and happening consistently and the gap is widening tells you something that no financial textbook will admit. The Western paper price is not a real price. It is a derivative, a reflection, a shadow on a cave wall. And the shadow is losing its connection to the object that casts it. The East knows this. China knows this. India knows this. That's why India imported $9.2 billion worth of silver in 2025, a 44% increase over 2024. despite silver prices nearly tripling in rupee terms. They didn't buy less as the price went up. They bought more. Because they're not buying a price, they're buying a physical asset in a world that is running out of it. And here's where I need you to understand something about the way modern civilization actually works. Forget the dusty textbooks about silver coins and pirate treasure. Silver in 2026 is not your grandfather's precious metal. Silver is the blood of the 21st century industrial machine. Every solar panel on every rooftop on every continent contains silver, not a little. Each standard photovoltaic module uses 15 to 20 grams of silver paste for the conductive fingers and bus bars that capture sunlight and convert it into electricity. In the first half of 2025 alone, the world installed 380 gigawatts of new solar capacity. That's a 64% increase from the year before. Over 700 million solar panels, each one eating silver. And when that silver gets fired into the paste and bonded to the cell and sealed under glass, it doesn't come back. It sits on that roof for 20 to 30 years. It disappears from the global supply chain permanently. Solar panels alone consumed roughly 448 million ounces of silver in the first half of 2025. That is more than half of total annual mine production. In 6 months, just from solar. But the hunger doesn't stop at your rooftop. Look at the electric car in your neighbor's driveway. A traditional gas-powered car uses about 15 to 28 grams of silver. An electric vehicle uses 25 to 50 grams, 67 to 79% more. And the world isn't slowing down on EVs. Global EV sales were up 21% year over year in 2025. Gartner forecasts 116 million EVs on roads by end of 2026, each one demanding nearly twice the silver of the car it replaced. Now add AI. The data centers powering ChatGPT, powering Claude, powering every large language model on Earth, they require servers packed with silver-containing components. Multi-layer ceramic capacitors, printed circuit boards, bonding wires. IT power capacity has increased 5,252% since the year 2000. Every watt of that increase means more hardware. More hardware means more silver. And here's the number that ties it all together. The Silver Institute reported that industrial fabrication demand hit a record 680.5 million ounces in 2024. That's 59% of total silver demand coming from industrial uses alone, not jewelry, not investment, industry, factories that cannot slow down, manufacturing lines that cannot pause, products that the world has decided it cannot live without, and every single one of them needs silver that is getting harder and harder to find. So demand is a vertical rocket. What about supply? This is where the story goes from alarming to genuinely frightening. Global mine production peaked in 2016 at roughly 900 million ounces. By 2025, it had fallen to an estimated 813 to 835 million ounces. Production is going down, not up. And here's the structural problem that makes this crisis fundamentally different from any other commodity squeeze in history. 71% of all silver mined on Earth comes as a byproduct, not from silver mines, from copper mines, from lead mines, from zinc mines, from gold mines. Silver is the thing they find while digging for something else. You cannot just flip a switch and produce more silver. You would have to open entirely new mines, which takes 8 to 12 years of exploration, permitting, and construction. And even then, ore grades are declining. The U.S. Geological Survey reports that average global silver ore grades have dropped roughly 30% over the past decade. The easy silver is gone. What's left is deeper, lower grade, more expensive, and harder to extract. And no new major silver mine can come online before 2030. That's 4 years of widening deficit with no supply cavalry on the horizon. The world needs 1.24 billion ounces. The world produces 1.01 billion. The gap is 230 million ounces per year and growing. By 2030, researchers at Oxford Economics project that supply may meet only 62 to 70% of demand. That's a world where nearly a third of the silver the planet needs simply doesn't exist. In economics, when you have vertical demand hitting a flatline supply wall, prices don't just rise, they detonate. And the people who understood this first were not the slow pension funds in London or the algorithmic traders in Connecticut. It was the sharks in the East. China controls approximately 2/3 of the world's silver refining capacity. 2/3. They don't just buy silver, they process it. They refine the raw ore from mines around the world into the 1,000-ounce bars that industry needs. And on January 1st, 2026, China did something that sent a shockwave through every serious commodities analyst on the planet. They restricted silver exports. New rules require that only large, state-approved companies with annual production capacity of at least 80 tons can export silver, and only after obtaining special government licenses. Hundreds of smaller and mid-sized exporters, companies that had been key suppliers to global industrial users for decades, were effectively shut out overnight. China looked at the global silver market, looked at the structural deficit, looked at its own strategic needs for solar, for EVs, for semiconductors, for nuclear power, for AI infrastructure, and made a decision. They're keeping it. They reclassified silver as a strategic material, the same classification as rare earths, the same classification as tungsten, the materials they consider essential to national security. When the country that refines 2/3 of the world's silver decides to restrict exports, that is not a market event. That is a geopolitical event, and it means that for the rest of the world, the supply deficit just got dramatically worse. SHFE warehouse stocks in Shanghai have fallen to their lowest level in nearly a decade. London vaults, which hold roughly half of all silver-backed ETF metal, saw severe depletion through 2025. COMEX registered inventories in the United States have dropped nearly 70% from their 2020 peak. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves, down from a historical norm of 90 to 120 days. The silver is being packed into containers, loaded onto ships, and taking a one-way cruise to the east. Western exchanges are turning into empty showrooms. They sell futures contracts, promises, pieces of paper that say silver. But when you take that paper and demand the actual metal, there's a growing chance they smile nervously and hand you cash instead. Try it yourself. Walk into your local bullion dealer tomorrow morning and ask to buy 1,000 ounces of silver. Look into their eyes. Watch the hesitation. They'll say, "We have to order. Wait 2 weeks, maybe 3. Because the metal isn't there. The supply chain is stretched like a guitar string, tuned 2 octaves too high. Refineries are running at maximum capacity but still can't produce bars fast enough. Mints are backlogged. The U.S. Mint paused Silver Eagle sales entirely. The 2026 American Silver Eagles aren't even available yet. APMEX's CEO publicly stated the market is under real strain. American Silver Eagles that normally carry a $5 to $8 premium over spot are selling for $95 to $165. That's a 22 to 110% premium. When the retail markup on a commodity is 100% above the official price is a lie. And the lie is getting harder to maintain. Silver lease rates, the cost of borrowing physical silver, have exploded from 0.3% to 8% annualized, a 16 times increase. The last time lease rates were this high was 2002, when the people who hold physical silver refuse to lend it because they're not confident it'll come back. That's not a market signal, that's a survival instinct, and it's the clearest indicator of genuine scarcity that exists in commodity markets. So here's where we stand. Demand is at record highs and accelerating. Supply has been in decline since 2016 with no fix possible before 2030. The cumulative deficit over 5 years is 820 million ounces. China just restricted exports and reclassified silver as strategic. Global inventories are at multi-decade lows. Physical premiums are at historic extremes. Lease rates haven't been this high in over 20 years. And the price on your screen, the number that is supposed to reflect all of this reality, is sitting at $70 to $80 while Shanghai pays $100+. That gap between paper and physical, between the shadow on the wall and the real object, is the $100 bill on the table that the smartest people in finance are refusing to pick up. And the question you need to ask yourself is not whether that gap will close. It will. It always does. Physics always wins. Geology always wins. You cannot print silver. The question is whether you'll be positioned when it closes or whether you'll be standing on the wrong side of the door when it slams shut. Now let me tell you about the people who are positioned, because this is the part that the mainstream will never show you. In a single day in early February 2026, the SLV Silver ETF recorded an inflow of 1,023 tons. That's 32.9 million ounces in one session, the third largest single-day inflow in SLV's entire history. Sprott's PSLV has added 10 million ounces since November and doubled their equity program to $2 billion. Since 2019, more than 1.1 billion ounces have been drawn from available mobile inventory to satisfy industrial demand and ETF backing requirements. That's metal being locked away in forms where it cannot easily re-enter the liquid market. Every ounce that goes into an ETF vault or a solar panel or an electric vehicle is an ounce that doesn't come back. And the institutions know this. They have the same data I just showed you. They have better data. They have contacts at bullion banks and refineries and mines. And they are buying at a pace that suggests they see exactly what's coming. Institutions don't buy when prices are rising and headlines are bullish. They buy when prices are falling and everyone else is scared. That is the oldest rule in finance. And right now, silver is down 35% from its January high. Headlines say crash, social media says bubble popped, retail is selling, and institutions are loading 33 million ounces in a day. If that doesn't tell you everything you need to know about who's on which side of this trade, nothing will. But let me bring this from macro to micro. Because understanding the big picture is only half the battle. The other half is knowing how to act on it. And this is where most people get it fatally wrong. Most amateur investors make the same mistake every time. They follow the crowd. They buy the names that have already gone up 10 times and hope for another 10%. They chase momentum instead of value, and they end up making other people rich instead of themselves. The real sharks in this market use a filter. 4 criteria. And if you find something that passes all 4, you don't ask what the name is. You ask where the buy button is. First, the cash fortress. In the mining industry, cash is oxygen. When markets freeze, and they always freeze, 90% of junior mining companies suffocate because they have no money. They can't pay geologists, they can't fuel drill rigs, they become zombies walking toward delisting. The company you want is sitting on enough cash to operate for 3 years without looking at a single shareholder. Cash gives you negotiating power, acquisition power, and most importantly, it means you don't go bankrupt while waiting for the market to wake up. Second, jurisdiction. Never, and I need you to hear this clearly, never put your capital into a mine located in a jurisdiction where the government can wake up tomorrow and decide your assets belong to the state. Geopolitical risk is the one risk you cannot hedge, cannot model, and cannot recover from. North America, Nevada, Alaska, Canada, places where property rights are protected by law and precedent, places where you can sleep at night knowing your mine will still be yours in the morning. The cheap numbers in unstable lands are cheap for a reason. Safety is the biggest profit you'll ever earn. Third, the free lunch. This is the criterion that separates the brilliant from the merely smart. Look for companies that own what's called money on the ground. In technical terms, tailings or shallow open pit deposits. These are materials that were discarded by miners 100 years ago because the technology to process them didn't exist. The miners in the 1900s took the gold nuggets the size of a fist and threw the rest away. They literally created artificial hills of crushed rock containing silver that they couldn't extract profitably. Today, with modern processing, those tailings are treasure. They're already crushed, already on the surface, already next to roads and infrastructure. You don't need to drill down thousands of meters. You don't need dynamite. You don't need ventilation systems or tunnel engineering. You drive a loader up to the pile, scoop it, and process it. When silver is at $80, those piles are profitable. When silver hits 120, those piles are money printers with nearly zero marginal cost. Finding a company with pre-existing surface silver is like buying an old pair of pants at a garage sale and finding a stack of hundreds in the pocket. Fourth, and this is the most critical, the valuation arbitrage. This is where you find the glitch in the matrix. Compare what the market is charging you per ounce of silver in the ground against what the industry considers fair value. The accepted market rate for peer companies is around $3 per ounce of in-ground silver resources. If you find a company where the market is pricing their silver at 40 or 50 cents an ounce, you found the $100 bill on the table for 41 cents. The gap between what you're paying and what the resource is worth is your margin of safety. Even if the market crashes, you've bought so far below intrinsic value that your downside is limited. But if the market corrects to fair value, your return isn't measured in percentages, it's measured in multiples. Cash, jurisdiction, low-cost extraction, cheap valuation. That's the formula. It sounds simple. But in a forest of noise, in a market where everyone is screaming about AI stocks and cryptocurrency and the next tech IPO, very few people have the patience to look at dusty rocks in Nevada. But when the inflation storm hits, you cannot eat AI. You cannot shelter inside a blockchain. You need real assets. And companies sitting on real assets at dirt-cheap valuations are the only lifeboats when the tide goes out. Now let me bring this home. You and I just walked through a long road together. Numbers, data, geological terms, market mechanics. I know this isn't as dopamine-friendly as a 15-second video of someone dancing, but you're still here. And that tells me something important about who you are. You're not looking for entertainment. You're looking for truth. And truth, in financial markets, is the most valuable and most rare commodity there is. So, what do you do tomorrow morning? First, patience. In resource investing, patience is not a virtue. It is a survival weapon. We've seen absurd numbers, 41 cents versus $3, a 700% gap. But the market can remain irrational longer than most people can remain solvent. That's why you never invest with rent money, never with your child's education fund, never with money you'd miss if it disappeared for 3 years. Use capital that, if you forgot about it entirely, your life would still be happy and normal. When you invest with that mindset, you become invincible. Silver drops 10%, you smile. Silver moves sideways for 6 months, you're calm. Because you know what you hold, you know the math, and you know that math always wins in the end. Second, use the filter. Write those 4 criteria down. Tape them to your monitor, Because the market is full of traps, companies that promise the world with empty bank accounts, companies sitting on real deposits in countries where a phone call from a general can seize your assets overnight. When you have the filter, you eliminate 99% of the garbage and focus only on the 1% of diamonds left in the rough. Third, and this is the part most people forget, stay an observer. The world is noisy. There will be days when the press declares silver dead, when the next cryptocurrency promises to replace every physical asset on Earth, when some talking head on television tells you that metals are relics of a primitive age. When that happens, look out your window. Look at the solar panels on your neighbor's roof. Look at the electric car in the parking lot. Look at the cell phone in your hand. Every single one of those objects required silver to exist. And every single one of those objects consumed silver that will never return to the market. That is your signal. Everything else is wind. The world is in the early stages of the largest wealth transfer in modern history, from paper to physical, from promises to possession, from the west to the east, 820 million ounces of deficit in 5 years, China restricting exports, India buying $9.2 billion of silver in a single year despite tripling prices, institutions loading record amounts while retail sells, mints unable to supply, vaults draining, lease rates at 2-decade highs, and the paper price, the number on your screen, still pretending none of this is happening. That pretense has an expiration date, and when it expires, the repricing won't be gradual, it won't be orderly, it will be the compressed spring that physics demands. The wider the gap between shadow and reality, the more violent the correction when the light shifts, and the light is shifting, you can feel it. That's why you clicked this video, that's why you're still here. Take care of yourself, take care of your family. The red and green numbers on a screen are not worth your peace of mind. Invest to become freer, not to become a slave to the ticker. Do your own research, read the reports, look at the data I've shared. Consider it a compass for navigating what comes next. If this breakdown helped you see what's actually happening, hit subscribe. Drop OG John AG in the comments. Share this with anyone who needs to understand what's really going on underneath the surface, because by the time the mainstream catches up to the data I just walked you through, the opportunity will already be gone. Stay sharp. OG John AG, out. Stay safe. I'll see you in the next one.